You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. This is your host, Jennings Smith. Guys, today I got a very special guest, Mr. Jason Seward, owner of 608B Capital. Guys, Jason has a hard money debt fund that investors put capital into. He also loans money, fix and flips, hard money lenders, second position, mezzanine lending. He's got the transactional funding. But I wanted to have Jason on the show because he is an example of unlocking his life. He left his W-2 job in 2023 and made the jump, focusing all in on real estate. That's what he's doing full time now. He has a couple investments in LP positions. He's built up 50 single family rental homes. He's got multifamily. Now he's got his debt fund that he's growing. He's building his presence on social media. So Jason, welcome to the show, man.
Yes, sir. Jennings, I appreciate you having me, man. I've been following along with you for quite some time. And, I'm always impressed with what you have going on, the content you put out there. And I'm happy to be on here, man.
Well, great. So tell me a little bit about yourself, because there are a lot of our listeners who are in real estate, kind of like you were for a long, long time. Looks like, you've been doing this for years and years, but then you finally made the leap. So what built up to you, first of all, getting into real estate? Tell me about your first real estate deal.
Yep. So the way I got into real estate was a very, I'll say kind of, I had a dreamer's mindset of like, I had one specific goal that I wanted, and I knew that real estate could get me there. So I'll take you there and then we'll go from there. When I graduated college, I went straight into a corporate sales job, selling insurance for a Virginia-based insurance company. And I stayed with that company for 18 years. But as soon as I started that career, I had some immediate success, good income, and I'm from a very small town in Virginia. So my only goal was to eventually buy some land and build my dream house on it. That was it, in my hometown. So I knew I could either continue earning, saving through my job, or I could tap into some real estate, which I had no strategy, no education around, but I knew that I could probably find some good deals in my area, flip them, do whatever I needed to do to build towards buying some land, building a house on. So my first deal, I was renting right out of college, a single wide trailer in my hometown.
Nice.
And went to the owner of that and asked him if he'd be willing to sell it to me. Went through the whole process. He owner financed the deal and came out of that where my mortgage was less than my rent. So I was like, man, this is easy. I can do this all day long. Ended up pulling that trailer out and building a single family home on it. Lived in it for a while.
Okay, so the trailer wasn't in a trailer park. It was just on a piece of land.
It was on a half-acre lot, here in my
So
hometown.
you weren't total trailer trash.
Hey, I got a lot of it in me, but yeah. So went through that, and like I said, I quickly moved the trailer out. I'd say quickly, in about the first year, moved the trailer out, moved in with a buddy of mine, built a house on that lot. And during all that, I got married. I was engaged and then ultimately got married. We moved into that new house. Probably 3 months into that house, a client of mine, insurance client, they passed away and their family was out of town, and they approached me asking if I knew anybody that might be interested in buying their grandmother's house. Old farmhouse, pretty much inhabitable. But I went and looked at it. They told me what they wanted for it. I knew what I could do to it and what I could sell it for. So I go home to my new bride and convince her, we're buying this house, we're moving into it, and we're selling this brand new construction home. So you can imagine that was our early test of my sales skills, but we were able to pull it off. And that started a snowball where we just kept over the next, a handful of years, buying property, buying houses. We'd move into them, fix them up while we were living in them. We didn't have kids yet. And we'd either rent them on the back end and then find our next one. And we did that a handful of times till ultimately I just kept running. And I didn't know anything about a 1031 exchange, nothing like that back then. But ultimately, it led to me buying a piece of land, 20 acres here in my hometown. And throughout all that, we had 2 kids and ended up building our dream house in 2015. So that, and I condensed that down a little bit because I went through a lot of real estate transactions to build towards that. But that was my start in real estate.
Well, let me stop you right there, because you said something that I want people to key in on. And if you're not listening closely, you might miss it. Jason was willing to do something that was uncomfortable. He was willing to do something outside of the box, where he was in a nice house, no cracks, no rotten siding, roof was brand new. He's comfortable, right? Got a good mortgage. Wife is happy, but he sees an opportunity, right? And the only way to capitalize on that is to get the money out of this house and put it into that house. But it shows kind of that ambition of, I'm willing to delay the gratification right now. I'm willing to not be comfortable, go do something that probably isn't going to be that fun. I'm sure that your wife did not want to do that.
It was not fun.
You know what's funny is my story is almost identical. I built a little house in a neighborhood, brand new. I got married and moved my wife in there. She loved that house. And 6 months later, an old, decrepit, broken down house in the downtown historic district came on the market for sale. And I said, babe, we're selling this house. And I'm going to move you into a rental home.
Right.
And then we're going to rehab this house and move into that. And when she got into that rental home, she was not happy with me. But
dude, I'm telling you, man, it took, because I had to take her over there and show her. I was like, obviously I'm not dictating like we're doing this no matter what. I had to get her on board with it. But the first time I took her over there, the house, there was a kitchen, but it was done. Like we had to gut it down to the dirt, basically the kitchen area. So we moved into that house with no kitchen. We had all of our fridge was plugged into what was the dining room of the house. And we had a little microwave and all that. But we just, once I got her on board, we were getting off work every day, just coming home. We were sanding floors, painting, doing all the stuff we need to do. Had a contractor doing the big stuff, but we just had fun with it, man. We just, without her getting on board and turning it into an adventure more than just this burden we were having to do to get, and we both saw the end game, which was, now the end game is different, but at the time it was building towards what we wanted. And we had fun with it. And we ended up, in the first 5 years of marriage, we moved 6 times. So we did this pretty quickly, over and over and over. And then once kids started showing up, it was like, no, we're done. Let's build the house and we're done with it. So, but yeah, it was a fun little journey and good memories for sure. So.
Yeah, no, I mean, at this point, if I told my wife, hey, we're selling this, and she would be like, heck no.
Yeah.
You may be doing that, but I'm not doing that.
Right. Yeah.
Okay, so how did you transit? Because it seems like your focus now is a lot on the lending, fix and flip lending.
Yep.
It sounds like you've got a lot of experience with that. How did that transpire? Well, tell me about your first couple of loans you did.
Yeah, well, I'll go back. So we built the house 2015. In my mindset then, I was like hardcore moving up the sales management ladder in my company. And, so that was my only focus. And I was done with real estate as a side hustle because again, I told you I had achieved what I set out to do in real estate, and that was to get my farm and my house. So I hit the brakes. I still had 2 rentals at that time, local, just houses I didn't sell when I was doing all my other stuff. But I wasn't going to expand any further at that time until 2018. So about 3 years went by and I didn't do anything in real estate. And a buddy of mine gave me, and this is such a cliche story, you hear it all the time, but a buddy of mine gave me Rich Dad, Poor Dad. And I know you've heard that a million times, but I read it and it's hard to explain. It's like a lot of people, it just unlocked a different mindset for me. I said, man, I know what I'm doing. I know how to do this. I've never done it with education or a strategy. Let me dip my toes back in and figure out a way to create a side hustle in real estate that ultimately then the goal became that could expedite my retirement, So instead of waiting until I'm 60 now, maybe I can get out of there by the time I'm 50. So I started researching, reading every book, watching all the podcasts, Bigger Pockets, all that stuff. And I settled on, all right, I'm going all in with the BRRRR strategy. So I started buying houses, fixing them up, refinancing them, holding them, renting them out. And I did that a handful of times. I think I did, 6 or 8 houses in 2018 and 19. Well, one of my best friends was also doing the exact same thing. And we were talking daily about it in the same market, but we weren't together. And we have complementary skill sets. I'm more of the networker, make a deal, negotiator, stuff like that. He's a numbers guy. So we joined forces in 2020 and just blew it up from there. We were buying, 3 or 4 houses at a time. We were flipping houses, burring, all while working our corporate job. And we were, at the same time, we kind of learned about lending. So we started lending some of our own private capital, right? And fast forward to 2023, beginning of last year, we both had gotten to a point where we bought a few small multifamilies. We were like, we know we've seen it. We know what we're doing. It might be a little step back financially, but this is our chance to dive all in and go all in and burn the ships, if you will, leave our corporate job. So we decided to do it. And it was measured. We had a lot of savings. Financially, we could do that, and at least take the gamble for a few years. And if it didn't work out, we got good resumes, we go back to work. But at that time, we both had big 401ks that we had to roll into a self-directed account. And that's where the lending started ramping up. We started both making hard money loans from our 401ks and saw very quickly that that's a profitable model. And that led to us. Do you know Kelly Garrett with Rehab Wallet? So we connected with Kelly Garrett, brought her on as a consultant. And for the last year, she has held our hand and basically, and she'll say it too, but held our hand in building a mini Rehab Wallet with the intent to scale to that level. And that's where we're at now. So that was a long-winded answer, but that's kind of how we got into the lending.
Gotcha.
Yep.
That's amazing. And I actually just dipped my toe into the hard money lending space this year.
Yeah.
And so far, so good. So we'll see.
Yeah, it's it was real important to us to build the foundation and structure of it all, even though we started very small. Like we started with no investor capital, right? So we didn't get our first investment in until July, but it started pouring in after that. But we had to have all the structures and processes and systems in place to run it smoothly because we're protecting investors' capital, right? So that's why it was so important for us to link up with a mentor such as Kelly, who could help us build it out. And now it's running smoothly, and we've opened up the valve on both ends, both raising capital and making loans. So, yep.
So is it hard to find people that need money?
Not at all. I think you know the answer there. Yeah. So there is no shortage of loan demand. Our model right now is predominantly most of our loans are in our own backyard. It's in the same market we're still doing deals in. So we're still actively flipping houses, buying rentals, all of that in our own market. But there's so many people doing it. So many people need capital. So far, knock on wood, it hasn't been hard to place money.
So talk to me about let's say I come to you and I say, Jason, look, I'm in your market. I'm looking to buy this house. I want to flip it. Like, what does it look like? Like, what are your qualifications?
Yep.
What's the LTV? What's the terms of the loan? How does that all work?
Yep. So we're a low doc lending company, meaning we're not pulling credit. We're asset-based lending. So we're going to underwrite 2 things. That's going to be the deal. So the house or whatever it is you're flipping, we'll underwrite that. And then we're going to underwrite you, the borrower. So we're going to want to know that it's very rare we're going to lend to a rookie flipper, right? We want to see that they either have some deals under their belt and they finish those deals, from cradle to grave. They've proven they can do it. Or we just lent to a contractor that has done hundreds of flips, but for somebody else, never done one on his own. But we know he can handle a rehab, So,
right.
So that's first and foremost. We need to feel good about the borrower. We need to feel good about the deal. The way we're going to underwrite the deal is very similar to how we're going to underwrite it if we would buy it. So we're going to look at what's your purchase price, what's your construction rehab, and what's that total in relation to the after repair value, ARV. We will lend up to 70% of that projected ARV. We will lend 90% of purchase and 100% of rehab as long as it's under that 70% of ARV or less.
So if I'm getting a house for $100,000, it's got a $50,000 rehab, ARV is 200. You'll loan me the $50K for the rehab. You'll loan me 90 of the purchase price. I got to come up with 10.
That's correct.
Actually, that's 75%
Yeah,
LTV.
yeah. Right now, it'd be 140 total in that example, but still, you're exactly right. And that it's a pretty standard. I mean, it's a typical hard money loan. I mean, most hard money lenders fall in that range. Our terms are, it's deal by deal. If somebody that has, if their deal is much lower LTV, so let's say they're at 50% of ARV total loan, we can be a little more flexible with our terms, but our terms typically start at 2 points. So that's going to be 2 percentage points on the whole deal. So if it's a $100,000 loan, you're going to pay $2,000 at closing, and starting at 12% APR monthly interest. So again, $100,000 loan, you're going to pay 12% monthly interest.
You mean annually, right?
What's that?
You mean annually, right?
Yeah, annually broken down monthly. Exactly.
I was like, dang.
Right. You're not going to pay 12% of the total monthly. We wouldn't make any loans. So, and it's not an annualized interest. So you're not paying 12% no matter what. It's just for the life of the loan, right? So it's, it's a percent a month essentially. And that's just a 6-month term. We have extension options if needed and if warranted. We're not going to extend somebody that buys a house 6 months later, they have not touched that house. They haven't done any of the renovations. But, if there's an issue, if like their exit strategy is to sell it on the back end and they went a little over time, they need an extra month, we'll extend them, So but that's our typical, and
it's the point to extend it.
Yeah, so we do a 3-month extension. So for 1.5 points, so 1.5 points to extend for 3 months.
And then is there any fees to exit the loan?
No fees to exit. No, all the fees are on the front end. So you got points and there's a lender fee on the front end as well. And then your interest, once you sell or refinance, you cash out the balance, we're done.
How do you handle the renovation dollars? Do you have to do inspections? Do you keep that money? Do you give that money to them at closing? I hope you don't.
No, we don't. Yeah, so we keep the renovation money essentially in escrow, and basically they're going to have to request draws. We're going to know the scope of rehab going into the loan. So we've vetted that out. We've verified that it indeed needs what they're saying needs to be done. And once they complete certain levels of or certain items on the rehab list, then we inspect it. Our inspections, again, if it's right in our backyard, we'll go by there, look at it, do everything we need to there. But we also offer, they can do a video walkthrough, or take pictures. Just depends on what we're looking at and inspecting. But once we approve it, we release the funds, but we're not releasing the funds ahead of the work, so it's got to be completed in order to get a draw.
Tell me about a loan that went bad. Tell me about a deal that went bad.
Yeah, so we had one this is going to end up working out okay because we're going to get the property back, and it's a property we would have bought anyway. But I'll tell you what went bad is, and I can't speak too many details about it, but I'll tell you the high level situation because we're still kind of in the middle of it. But we had a borrower come to us. Actually, we sought out that borrower. He's a big player in our area, and we wanted his business or just a fraction of it. So we went fishing for him, and we finally got him, got a meeting with him, and made a loan. 3 months into the loan, I did a drive-by. There was nothing being done, nothing to the house. Now, we just loaned for the purchase. We're holding rehab money, so we're not any money out. but he hadn't requested a draw, he really hadn't communicated with us. And probably 2 weeks after I did that drive-by and trying to connect with him, we got notification that he was in bankruptcy and had filed for bankruptcy. And we were one of the creditors that were listed. And essentially, we've had to go through the process, and I don't know if you've been through that or not with anyone, but it's kind of a drawn-out process. But at the end of the day, it just goes through the foreclosure process. We'll get the house back, and we'll do the project that we would have done anyway. The lesson there for us was we were so eager to get his business. We didn't vet him as strongly as we should have. We were eager to get his business because we knew his name. We knew he was doing a high volume of deals, and that was good enough for us. Hindsight, we should have spent a little more time with him, vetting him out, and talking to other folks that he had done business with, and we would have found out probably some red flags So that was one that went bad. That's really the only one we've had go bad so far. So,
how long is that foreclosure going to take, especially with him being in bankruptcy?
There's a lot of layers to this. The type of bankruptcy. Well, I'll keep it high level. We should have our hands on that property in 2 months. So about 2 months. Yeah, it's not too bad.
When did you make the loan?
We made the loan it was about 6.5 months ago. So everything's going to be.
It's not 9 months. That's not too bad.
It's not terrible. And honestly, we don't make loans hoping for this to happen. But as I mentioned earlier, we kind of look at it, again, we're trying to do most of these in our market. Well, we'll lend in other markets that we have connections and boots on the ground that can kind of be our eyes on a project. But in our market, if this guy had wholesaled us this deal in the beginning, we would have bought it from him,
Right.
So it's very easy for us to make that loan knowing that if it goes to foreclosure and we got to take it back, it's fine. We'll go in, we'll get our contractor in there, and we'll either hold it as a rental or flip it. So it's not a terrible thing.
Or you could even assign that loan to another trusted flipper in your market.
Exactly right. Yep.
Yeah.
So, but yeah, that's pretty much it. And again, with our terms, if you shop other hard money lenders in our area, you're going to see very similar terms. So, how do we separate ourselves? Well, number one, we're investors too. Like we're dealing with the same deals that we're lending on. We own and operate the fund. We're not brokers. So the money is in-house. We hold the keys to the money. So if we approve it, we can wire it that day if needed, So that makes us a lot more nimble in the transactions. So.
Gotcha. Now, let's say I'm interested in the fund on the investment side. Mm-hmm. So what's in it for me and how does that work?
Yep. So we have three. So we're a 506C for accredited investors only. So that's important to note. And we have 3 investor classes, and I'll run through them real quick. The minimum investment is $25,000. That class goes up to $99,999, and we pay an 8% fixed return on that. It's paid distributions are monthly, or it compounds monthly if folks want to leave their returns in. Next class is $100,000 to $499,900, or $499,000, and that is 9% fixed return, paid monthly or compounded monthly. And our third class is $500,000 and above, 10% fixed, paid monthly or compounded monthly. So those are our 3 classes. We have the ability to do side letters. So if we have an investor come in with a really big check writing capability, 7 figures plus, we can do a longer hold on the money and a little bit better return. For the 3 classes I mentioned, we lock the money up for 6 months, and then it becomes liquid after that. So it's a 6-month initial hold, and then after that, you want to call a portion or all of it back, we have 90 days to get it back to you. So,
Gotcha. So, on your side, there's a delta there, right? If you're getting it for 8 and you're loaning it for 12, plus you're getting 2 points, plus you may be getting extension fees, and then there's also some other lending fees, I'm sure, up front. But you do, I'm sure, have operational costs, right? You got to vet these deals and you got to do the paperwork and all the closings and the
Exactly.
construction inspections and on and on and on.
Yep.
So my thought with that is, how do you balance, like, let's say I come to you and I say, all right, Jason, I'm gonna give you $500,000 and I'm, next month I want my distribution. Are you able to get that money in play? Because it seems like you're now putting yourself on a wheel of like, man, I gotta have this capital out on the street, right?
Yep, that's the name of the game. We got to keep it's on us to keep the money working. So in your example, you come to us, say, I got $500,000 I want to place, at 10%. So when you wire us the money, your interest starts accruing the sooner of when we place any portion of that capital into a deal. So if you bring 500 and we have a loan to make next week for 150, we pull 150 out of that and that goes into the deal. That day, your whole 500 starts accruing interest. So it's the sooner of that or 4 weeks. If we go 4 weeks without placing that capital, that's on us. But we start paying interest at week 4. So we disclose that up front. And we've yet to go 4 weeks before placing any capital. But that potential is there that an investor could come in and that investment stay not earning interest for up to 4 weeks.
I guess worst case, you could just give the money back and say, look, I just don't have the deal flow right now.
Yeah, that's it. But like I said, it's from an operational standpoint. So it's 3 of us, right? Just three business partners in this. We all have our own lanes, but we are constantly marketing what we have available. And again, that's through network meetings, social media, all that stuff. And there's no short. We have 3 to 4 times the volume of deals to place money than we do money, and no matter how much money has come in, that has not changed. The more money comes in, the harder we pull the lever on marketing to borrowers. Another thing we have is a relationship with, I mentioned Rehab Wallet. If let's say we do have a huge volume of loans, we just don't have the capital to put in those loans, but it's a good borrower, we want to do that deal, we can broker that loan through Rehab Wallet, and we are structured identically to them. So, if we approve that loan, we pass it off to them, they're going to do a quick check and most likely approve it, and we pass that borrower on to them. But it's still under our brand, if that makes sense.
Yeah. So you get a guy, you may not have the money to loan him, but you don't want to lose him as a customer. Correct. And so you can still underwrite him and fund him through a partnership or not. Yep. Yeah, I gotcha.
Yep.
Okay. And tell me a little bit about the other lending products. You talked about second position or mezzanine or earnest money, maybe. I mean, you didn't mention that, but what other things do you do?
Yeah. So I mentioned earlier that, I think before we started recording, but that I have, the way I got into lending at first was, I was almost 20 years in a high paying career that I was maxing out my 401k every year. So I was getting good returns on that. So I had a big block of money that I rolled it all into essentially a solo 401k that I self-direct now. And so I use the bulk of that capital to lend or invest in various deals. Got a little bit into some syndications and whatnot, but that's my capital. That is not investors' capital. So I'm willing to get a little riskier with that, but it's all measured. But those types of deals I've done a handful of second position where, let's say I've got quite a bit out to a developer who has a first position construction loan, but they had to bring 20% of the construction cost. So I would fund that in a second position loan and get much higher returns. I mean, on those loans, I'm getting 20 plus %. And I've got that. I can do double closing, which is basically where instead of a wholesaler selling a contract for an assignment fee, they're going to own it for just a short period of time. And then at that same day, typically, that is going to be owned by that wholesaler and then sold to an end buyer and it's avoiding that whole assignment process. Well, a lot of times in order for that wholesaler to do that and transact on that, they have to bring that money to closing, even if it's just for an hour. So I can fund that. So let's say they're buying something for 100. selling it for 120, and that's all going to transact on that day at the closing attorney's office, I'll wire 100 grand in. I'll get a point, 2 points, 3 points. Depends on how long it's going to be out. Typically, I don't like it out more than a week, but it never actually hits anybody's hands other than the closing attorney. So it's going to go out, and that's going to be the wholesaler's money to buy it, and then it's going to be sold to the end buyer, and then I'm going to get my money back with points at that second closing. So I can do that. We can actually lend like that through the fund as well, but we haven't yet. But I've done, some of that through my own capital.
Yeah, I have done that too. And I find that there isn't as much demand for that product because it's so risk-free for the lender. Like there isn't a whole lot of risk for the lender, which is why I've done it.
Yep.
But it's hard to compete, and get those deals.
So. Well, this is why we are, as recent as the last few weeks, we are marketing through the fund our ability to do that, and that we have a product for it because we're in Virginia, and Virginia just passed, or the law goes in effect July 1st, where wholesalers, if they don't have a real estate license, they can no longer assign contracts. That's a huge deal in Virginia. So now for a wholesaler to continue operating, they're either going to have to, one, get a license, or two, evolve to a double closing model. They can't assign it, so they have to double close. And there's going to be a lot of that, a big demand of that come July 1st. So we are marketing now in Virginia primarily that we have that ability. So
there you go. All right. The government, man, they trying to, protect everybody, but they're just going to line your pockets.
Whatever, man. I don't get too down into the weeds of the why or, the rules or whatever. I just see what they are and see if there's a way that, we can, provide value given whatever the rules are. So, and make money.
Yeah, the loan that we did, it wasn't a first position loan. It was kind of like what you're talking about, more on the equity side. And so the risk is higher. And we got compensated for it. I used my money for it. I didn't use investor capital for that. Yeah. Because like I said, if you're doing this at scale, something's going to go bad. And if you are an equity check writer in some syndication or whatever at an interest rate, like there's not gonna be anything left for you. That's going to be a total loss. Whereas if you loan 70 grand on $100,000 house, well, you still got the house, and eventually you're going to get that back, and eventually you're going to recoup it. Maybe you didn't make the interest you thought you would, but you didn't lose investor capital.
That's right. And one thing I want to go back on the investor side, because this is where, it's the same model as Rehab Wallet, but both of our companies are very unique in this sense. A lot of your hard money lenders that are raising investor capital, it's on a per deal basis. So you come to me, you got a $200,000 loan you need. I go to John Smith Investor. I'll say, hey, do you want to invest in 123 Main Street? And I'm basically a connector, right? So I'm connecting them, and then I'm just getting some fees, points, whatever the case may be. But that investor is tied to that property. That investor's name or their LLC is first mortgagee. So where we do it a lot differently is our investors come in and they are just put into a pool of capital, right? And then, which is inside of our fund. Our fund takes first position or second position on any loans we make. And it is a way to basically distribute investors' capital over our entire loan portfolio. So that one deal that I mentioned earlier that's going south, no one investor feels that, right? Because it's a very small fraction of what we have out there. So no one investor is going to get pulled into a foreclosure or...
Well, now, and do they have to partake in the downside of that, or do you cover that?
We cover it. Our model, and I could get into the weeds of the way all the numbers work. So the quicker we turn loans, the way this becomes more profitable or is more profitable is recycling that capital. So if an investor gives us 200 grand of an investment, we're paying him 8%. Well, if we can make 2 to 3 loans in an annual basis off that money, we're getting 2 to 3 times on our points, our fees, all of that, plus the spread of interest. So that is where things ramp up. And, it's on us as operators to keep that money working and keep it recycling as quick as possible, and then we absorb any losses we have in the event of because there's going to be foreclosures as we scale, right? We're going to run into that. And if one ends up losing us 20 grand, well, everything else we have out there we absorb it, the investors don't.
So how much capital, like what size is the fund? I mean, I know you just got going with it this year, right?
Yeah. We just got over 5 million in loans since July, and we have a pool of investor capital. And that's a couple, we've recycled a couple loans since we started. So that's 5 million in loans. Our investor capital now, I don't have it in front of me. I think we're 3.5 million. And that's been, mostly 100,000 at a time. So we've gotten a lot of investors in. We've got a couple bigger check writers, but we've also, as we've kind of proven the model and gone through some loans, we've had some higher net worth investors kind of sitting on the sidelines, just wanting to see us operate for a little while. And we have a couple commitments here in the last week that's going to scale us pretty quick, So it's exciting,
Where do you see the fund going? Like, what size would you like it to be?
The goal by the end of 2024 is to be at 10 million in investor capital. And then ultimately we'd like to grow. I don't want to ever set a ceiling, so if this thing grows and continues to grow, hell, Rehab Wallet went from zero to a $200 million fund in about 5 years, so we have seen behind the curtain of how they operate and how they did that. And they're helping us along the way. I see no reason if we choose to go that route that we can't get it to that level as well, So,
Yeah,
that's amazing. But short term, 10 million by the end of the year is our hard goal. And we've kind of backed into all of our KPIs and activities to get there between now and the end of the year. So.
Gotcha. And what city in Virginia are you in? Like what area?
Yep. So where I live is Surrey County, Virginia. You've never heard of it. Nobody listening has. I'm in a very small town, but it is the Hampton Roads, Richmond market is where we're at. So south of Richmond, north of Virginia Beach. So kind of on towards the east coast of Virginia. And
one of my property managers is based out of Hampton Roads.
Who is it? Or if you don't mind.
It's RPM Hampton Roads.
Yeah, I'm familiar with them. Yeah, Hampton Roads is a great area. It's a big military area. And we've had a lot of luck with single family homes in this area. And now we've converted some single families to midterm rentals and having some good success with that. But yeah, I love the area. And one of my business partners I got to mention this, he's in Raleigh, North Carolina, or just south of Raleigh. So we have quite a bit in that market as well, doing loans down there as well. So
who's that partner?
Tim Blodgett.
Tim Blodgett. Okay, I know that name.
Yeah.
Yeah, and my cousin, he lives in Richmond and has a large portfolio of mostly like A-class, smaller multifamily. He owns the RPM Richmond franchise, but he spoke at my conference. Ralph Reard might be a good guy to connect with.
Yeah, absolutely. Yeah, offline, I'll get his info. I was up in Richmond Tuesday night. I mentioned I was at a meetup there, and so that we own property up that way, but we haven't really networked very much that way. It's mostly been the Hampton Roads, Virginia Beach, Norfolk market that we've done most of our marketing and networking. But now I'm branching out towards Richmond and connecting with folks up there. So.
Okay, I'm going to ask one more question.
Sure.
I think that listeners may be wondering, because I'm wondering it. How much money can you make with this business, right?
Yeah.
Like, let's say you do get to 10 million. I feel like that's a pretty good milestone where you've got some scale. You're not too huge, but you're not, hey, I'm only loaning out $1 million. We got 3 people eating out of it. So it really isn't. I'm sure this thing wasn't that profitable when you started it, or maybe it still isn't too profitable.
No, we just got it to a point where, we're able to take a draw, but it's not a lot. And it never was originally meant to be the main thing. It was just a thing that we can do to supplement whatever, because we're still actively buying and doing other stuff. But now that we've kind of, again, seen behind the curtains and we are now experiencing, some loan recycles and seeing how all this operates, I'll base it off a $10 million fund. the way we are modeled, very conservatively, if we average so 2 loans a year off of investor capital. Somebody gives us $1 million, we recycle that twice in a year.
And really, let me interrupt you, because that is probably pretty conservative, because even if they do extend, they still got to pay 1.5 points, and that's for only 3 more months. And if they got to extend again, there's another 1.5 points. There's 3 points instead of 2 points. So it's like, I think that is a good basis of you should be able to get 4 points at least a year on it.
Correct. And, we, well, our average loan so far is right at 4 months. So if you project that out, which is getting a little less conservative, but we recycle that money 3 times at our current average. So it has potential to be way better than what I'm getting ready to share. But we model everything at a net of 8% off of the investor capital that we have.
Okay.
So, yep. And that's a net profit of 8%. So you do the math on that on a $10 million fund, that should be annualized $800,000 net profit. And I can give you the formula for all that. We'd be here for a while, but that is where we are operating at conservatively.
No, it's good to kind of know that, to be like, is this worth doing, right? Is this worth putting the effort into? And does that include like your overhead of, all the paperwork processing and all that? Or is that mostly just you guys working for free?
So that 800,000 is before us taking any owner draws. Okay. So I want to be clear about that.
Yeah, I get that.
Or that 8% again. So on a $10 million, we expect conservatively, without paying ourselves, to net 800 grand in profit. So operational cost, other than the startup. So we had to put together our syndication. We had a lot of legal documents, had to put our loan docs together. That was a big startup cost. Outside of that, our operational costs now, a lot of it gets built into the lender fees, right? So every loan we make, we get a BPO done, a broker pricing opinion. It's like a mini appraisal. That cost us a couple $100. Well, that's passed on to the borrower through lender fees. The rest of our operational costs right now are marketing. We have connected with, I don't know if you're familiar with Legacy Digital Media out of Charleston, South Carolina, Hugh Patterson. Anyway, they have a social media marketing company. And so we hired them. They handle all of our marketing. That's a pretty hefty cost. But outside of that, these loan transactions, all the costs have been paid up front. So all the doc preparation and stuff like that, we've already paid those costs. Each loan does not cost us an additional fee, and whatever little bit it does through the BPO or time or whatever you want to label as a cost is passed on in the form of lender fees. Does that make sense?
What about the underwriting of, if you're getting inundated with like, I want a loan. I'm sure there's a lot of legwork is like, do we trust this guy? Is this a good house, et cetera, et cetera? Yep. How is that due diligence? Even the construction project, like, is this bid accurate? Can they really get it done for 50 grand or 30 grand?
Yeah. So up through the time we started making loans in July through now, we have handled everything ourselves. So one of my partners, Bill Phillips, he is the primary underwriter, loan approval, handles all the draws, all of that. So my lane is typically 90% of my time is spent raising capital. So that's kind of my lane. But we have gotten to the point where here, probably another $2 million in investor capital, we will hire to replace what Bill was doing. So we're going to hire and train someone to do all the transactional things he's doing. So the underwriting, and there will be a period where he'll still be doing it while coaching and training and mentoring them. But ultimately, our intent is to, everything that is time consuming in this business for us is to hire employees to handle that as we scale. So as we get there, that adds to the operational cost, that you were asking about earlier. But we've got to hit certain milestones of investor capital, which equates to profits, to be able to then bring on staff. So from a time standpoint, we're right on that. Bill stays busy all day, every day, working these loans. And we get a lot of loan requests, and he's got to weed through them all and underwrite them and all that. So that is our first hire for sure.
Yeah. Yeah. But let's say you have to go and hire away some bank underwriter to train for your deal. I mean, what's that going to cost you? $100,000 or something?
Yeah, it's not. I mean, it's once we get to that point, we free him up to do other responsibilities, or again, we have other stuff outside of this fund. Ultimately, the fund is kind of. I'm sure you've heard this, but you got your fast money, your medium money, your long money, and the fund right now. Once as we get it up and going, that's our fast money. Every loan we make, we're pulling points off of it, right? So that's fast money. But I didn't leave my job to create another 100-hour-a-week job for myself, right? So the whole goal here is to build something that we can replace the time that with employees to do the things we're doing, so we can take the capital that it's producing and invest in real estate ourselves. Because we want to continue to invest in real estate, whether it be LP and syndications or local properties that we're buying ourselves for the tax benefits and all that.
So yeah, I mean, how many employees does Rehab Wallet have, do you think?
12 to 15. But listen to this. This blows my mind, or blew my mind when we started working with them. They have doubled their investor capital. They've doubled their loan volume, and they still have the same staff they had with half the volume. So once the staff is in place, handling these things, it's not like once you scale to 3x what you are now, that doesn't mean you have to go 3x staff. There's a lot of automation that can come into place once you properly staff. So,
because once you underwrite a loan and approve it and fund it, it's probably not that much more ongoing other than the renovation side.
No, yeah, and they're most of their staff is it's a lot of they have loan officers, loan originators that are handling all the front end stuff. Then they have staff that's handling all the draws. And then they have staff that's handling all the recycled money that's coming back in and making sure that has a home when it comes back through. And then they have compliance, a couple of compliance employees. But I mean, that Kelly, like she said, their next 200 million in growth isn't going to require more than 2 or 3 more employees, because they reach a point where everything just kind of becomes automated, so.
Yeah, no, that's amazing. And I think that when you think about scale, something that I really like about the Deal Room, which is our program, is it has scale to some point, but if we add another member to the Deal Room, like it isn't incrementally that much harder, because they're coming on the Zoom calls, et cetera, et cetera. Now there comes a point where, okay, you got to add more sprint teams and you have to add more weekly calls and more underwriting calls to make sure everybody's getting what they need. But when you buy another apartment complex, you got to go. It's got more scale than a single family, but you still got to go rehab that complex, turn over the rents, manage the property manager, or do the management yourself, and et cetera, et cetera. And so when I first started, I'm kind of like where you are now, that we had 3 deals and we were overlooking everything and et cetera, et cetera. And as we grew to 14 deals, it's like, okay, I got to have help and I got to have staff, and the growing pains and going from continuing to scale. Now, a lot of deals I'm doing is I'm just partnering with in-place operators and helping them get the capital that they need so that they can build their portfolio and they live local and their eyes on the ball and they're on site every week. And that way I can continue to grow. But I see the vision of what you're doing here. It's like, okay, yeah, $3 million in investor capital times 8% is only 250 grand or whatever that is. And by the time you cover your overhead and your startup fees, you're not making any money, but you're looking to where, okay, I can get to 10 million. Once I absorb that and figure that out, I can go to 30. Once I figure that out, I can go to 100. Yep. And where did Lima One start? They probably started like you started,
Exactly. Yep.
So would you ever move into bigger deals like multifamily or commercial stuff or anything like that?
Yeah. Yes. We will. So something I haven't touched on other stuff with. So we raise capital for other folks' syndications as well. So we get a slice of equity, we've done that for a couple deals now. So we have that going on, but we don't do that through the fund. Our fund, because it's an SEC regulated fund, we've got to be very specific on what we can lend on, what we can't, and because that's what we sell to our investors. So I can't take somebody park $500,000 with us, and I take that $500,000 and put it in one of your syndications, just locking it up for 5 years. That's not a good use of that for our model. But
that's not what they signed up for. Yeah,
exactly. So to answer your question, we are probably, I would say, by the end of this year, we will have a second fund that is going to be more of an equity-based fund where we're essentially capital raisers for other folks' larger commercial deals, whether that be storage, apartments, whatnot. So, because we have a big investor pool of folks that are interested in those types of deals too. And we don't currently have, in our fund, we can't offer that, so we've got to figure out a way to be the connector, from that capital to other operators. So.
Well, hey, I'm just looking at the time. I got so engrossed in the numbers. I mean, I'm a number guy, but we do got to probably wrap it up. But Jason, if people are living in the Virginia area, needing money, or if they are living anywhere and looking to deploy money, how do they connect with you?
All right. The easiest way is our website is www.608b as in boy, capital.com. Real quick, that 608B capital, 608B. A lot of people, we get asked all the time, is that some kind of, financial, what is it? My primary business partner that we've been buying houses for years with, we went to Radford University here in Virginia together, and our apartment number was 608B. So that's the name for anybody confused by that. But that's our website. You can go there, and all of our social media is on there, our contact info. You can, if you want to borrow, submit a borrow form through there. It's all very intuitive and easy to work through our website. And then I'm on all the social media, just my name, Jason Seward. And then we have 608B Capital on all the social media as well. You'll find that all on our website. So.
Okay, so 608B as in boy, capital.com if you want to connect with Jason. But I really enjoyed learning about your product and your business. It's super exciting. So thanks for being on, and make sure you guys take some time to connect with Jason and unlock your life. Peace.
Jennings, I appreciate it, man.
Thank you, sir.
Yes, sir.
This is the podcastfactory.com.